Take a look at a major government school construction project in full swing. You see cranes moving, concrete pouring, and hard hats on the ground. Behind all that physical motion is a massive financial drain. The contractor pays out thousands every single day to cover weekly wages, equipment rentals, and material suppliers. And while the money flows out, the revenue column remains completely empty. Not a single cent has entered the contractor's bank account yet. The visible growth on site is a race against insolvency, with the company's survival depending on a paycheck arriving before the cash runs out. You cannot finance a massive infrastructure project the way you run a retail store. These jobs take years to build, and no contractor has the capital to float the entire cost up front. This is why the industry relies on progressive supplies. The construction timeline is broken down into monthly fractions, allowing the contractor to bill for the exact amount of work completed in that specific window. By the end of month 1, the contractor's cash reserves are usually exhausted. They have to formally ask the employer to replenish those funds based on the progress they have made. Securing that monthly progress payment on time is the absolute prerequisite to buying materials and funding the next block of work. At the end of the month, the contractor sits down in a site office with the quantity surveyor, or QS, and the principal agent to assess what was actually built. The contractor submits a claim. This number represents the exact monetary value of the labor, steel, and concrete they have expended over the last 30 days. The QS then evaluates that physical work. They frequently dispute the progress, which legally strips down the initial value of the contractor's claim. Then comes the second cut. The employer applies a retention, a contractual mechanism that permanently withholds a percentage of the money as a quality guarantee. Only after these aggressive deductions does the principal agent finalize the agreement by issuing a formal document known as an interim payment certificate. That certified amount is substantially less than what the contractor actually spent to do the work. They are starting the month operating at a cash deficit, and that is before the tax authority gets involved. The moment that interim payment certificate is issued, it triggers a dangerous liability with the National Revenue Service. Under Section 9(3)(b) of the VAT Act, the signing of this certificate legally establishes what is called the time of supply. Looking directly at the official tax guidelines, we can see exactly how this rule applies to progressive construction contracts. The specific legal text states that the tax liability is triggered at the earliest date payment is due, is received, or an invoice relating to the payment is issued. Look at example 7 for a practical calculation. If a contractor builds 10% of a 6.5 million rand project in month 1, they generate an immediate VAT obligation of over 84,000 rand. The contractor now legally owes 15% VAT on the entire certified amount to the government for that specific tax period. The tax authority treats that piece of certified paper as realized revenue, immediately demanding cash from a contractor who has not yet been paid. The national deadline is uncompromising. The VAT return and the physical cash payment must be submitted by the 25th of the following month. But governments and large employers operate on entirely different schedules. They routinely delay actually paying the certificate for 60 to 90 days. As the 25th approaches, panic sets in. The contractor knows they lack the liquid cash to satisfy the revenue service. If that VAT payment is even a single day late, the government immediately applies severe financial penalties and compounding interest. This brutal gap between the tax point and the actual payment effectively forces the contractor to finance the government's revenue using their own drained reserves. This creates what is known as phantom profit. The money exists on the accountant's spreadsheet and on the tax returns, but it is completely absent from the actual bank account. To pay the VAT bill on time and avoid legal trouble, the contractor must scrape together whatever cash reserves they have left and drain them completely. When the reserves run dry, they are forced to take out high-interest, short-term commercial loans for the sole purpose of paying their taxes. The exorbitant interest on those emergency loans eats directly into whatever razor-thin profit margin the project originally had. At this point, the contractor is essentially paying for the privilege of working, slowly cannibalizing their own company just to stay compliant. It only takes one delayed payment from an employer, combined with a drained bank account, to trigger an immediate domino effect. Payrolls are missed, material deliveries halt, the site freezes. Once the site goes quiet, no new work can be certified. The contractor's monthly lifeline is permanently severed. The final outcome is a bankrupt contractor, unpaid workers, and a half-built piece of critical infrastructure left to rot. These businesses fail when the misalignment between payment timing and tax laws systematically destroys their cash flow.